Hello, everybody. July 28th, Scott Riley, the market update desk with Mortgage One, NMLS number 157524. Newsflash, I am starting my campaign to have the general manager and manager job for the head coach job for the Detroit Tigers. AJ Hinch is driving me nuts. Scott Harris is driving me nuts. Hopefully, I can become both those positions and maybe even a part time relief pitcher and outfielder to help the team get to the playoffs. But besides that, let's go over what's happening today. So, today kicks off the Fed's 2 day meeting with their rate decision coming tomorrow at 2 o'clock Eastern Time. Now, ex Fed Governor Stephen Miran spoke on CNBC this morning. Now, his term was up at the end of May this year. He made some very good points this morning on why the Fed should not be looking at hiking. Number one, for starters, he said the inflation measures we have are overstated and pointing to one specific data point, portfolio management, which we have talked about extensively. He explained that it's adding about 0.4% to the year over year inflation, but in fact, it should be deflationary because ETF fees and brokerage fees have been on a race to the bottom, decreasing each year. The dollar amount has increased because portfolios have increased, but the percentages have stayed static. So it really should be a non factor within inflation. He also asked what has changed since the last meeting when the Fed unanimously voted to leave rates unchanged. Now, since then, we got the June CPI report. That came in with a negative monthly reading, which means not a reason to hike. Now, back in 2021, he was one of the louder voices saying the Fed should be hiking rates because the money supply was rising and inflation expectations were no longer anchored and rising. What did we find out from all that? We just kept having more inflation because they printed more money. Fed didn't listen to it. Now money supply is stable and inflation expectations are well anchored, as Fed Chair Warsh indicated at the last meeting. Now, Fed futures, they're pricing in about a 33% chance of a quarter point rate hike tomorrow. But we're not thinking they're going to. That's just the current poly market betting. Now, we did get inflation data today. Case-Shiller showed that home values rose 0.6% on an unadjusted basis, and over the last 3 months, home values on average nationwide have risen 2.1%. So that's real solid appreciation numbers. FHFA, Federal Housing Finance Agency, now they only measure homes with conforming loan limits and exclude cash transaction, showed that home values rose 0.3 after season adjustment and are up 2.2% year over year. Now, I always asterisk that locally, we're much stronger than a 2.2%, but that's nationally. On the employment front, we got ADP. They released their weekly employment report for the week ending July 11th. That showed on an average, there were 15,000 jobs created per week over the past 4 weeks. So based on this, the next jobs report we get next week for ADP is probably only going to show plus or minus 65,000 jobs. Kind of a weak report. Now, interesting, when we get that, and then the next couple statements, many of the hawkish Fed members are using recovering labor market data in their arguments for a rate hike. But the last BLS report was weak, and as we can see, the current ADP is not strong. Plus, we're losing the temporary bump that we got from the World Cup temporary hiring. So we really shouldn't be looking at a hike. The data shows that. In response today, we are seeing geopolitically potentially continued pausing, I guess we'll call it, in the Middle East with Iran, United States, Houthis, Saudi Arabia. So we are getting a dip in oil again today. In fact, oil's down 442 to 78.19 a barrel, and Brent Crude's down 5 to 83.37 a barrel. That's pushing the 10-year yield down to 4.592%. Dow's up 642. Now, keep in mind, we had been down in the Dow, but we are now back over 52,850 on the Dow index. Mortgage bonds, We're getting a nice little bump. Those are up 6 basis points, and we are reaching close to a topside resistance of 101.39. On the treasuries, we have been trending down. We were at 472. As I indicated, we're at 4592. Now our next level of resistance is 4.588. So not much lower than where we are right now. The key there is will we break below it and hold for a closing? Stay tuned. Got a lot going on the rest of the week. Give us a call. We'll help break down the numbers for you, help you get pre-approved, go over loan programs, different mortgage insurance options, and help you understand why being a buyer right now in a slightly elevated interest rate environment actually is a positive for you. 616-293-2189. Scott Riley at the Market Update Desk, which is, of course, your original singular market news source for West Michigan.